What's good, everybody? And welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. Please like, please subscribe, please share the episode. I would really truly appreciate it. Please note anything discussed in this episode is not financial advice. Please do your own research before investing into any stock. This episode, we're going to talk about current market conditions. We are now entering the last month of Q1, and it's a very good time to reflect and see where we have been over the last 2 months and see where we're going for the remainder of Q1, Q2, and the remainder of this year to see what kind of alpha we can get on our portfolios, i.e., what type of return. To start off, let's look at a chart of the S&P 500. This chart represents the daily price action for the S&P 500 index over a year's time span. These red and green bars, known as candlesticks, represent the specific price action for a given day. A red candle means that the market was down for that day, and a green candle means that the market is up for that day. Now let's talk about the levels that we have reached in the past 2 months and look at where we are right now. The all-time high for the S&P 500 was 4,818.62. This level happened back in the first week of trading in early January. After that happened, we retreated down all the way to the level of 4,222.62. That was at the end of January, and that was a low. We came back up and we tested the level of 4,590. So these levels were considered support and resistance. Resistance means the top, support means the bottom. That 4,590 level is a resistance level because we did not break through that to get to the all-time high. So after we came from the 4,590 level, we came all the way down back to 4,222.62, and we retested that level. Sometimes with certain stocks, we will have what we call retest. That is pretty much just a technical analysis term to see if we will come to that level, if we will either break lower or come back up to see if we have reached a true bottom in the market. However, this was not the bottom, and we broke through this retest level and we came all the way down to the level of 4,114.65. We came down to this level last week, and the market flashed down because of the market uncertainty and the fears on Russia invading Ukraine. This day was very interesting because the market opened up down 2.5%, but it ended up 1.5%. That is an intraday change of 4% in one particular day if you bought at the bottom. A day like that is unheard of, and it's really only happened a few times in the last 20 to 25 years. After that, we came back up, and now we are residing around the level of 4,306.27 at the making of this video. Now I have the level marked of 4,297.75. The reason why I have that level marked is because that's a level that the S&P 500 has touched multiple times. We touched that level back in July of 21, back in September and October of 21. We touched that level after we touched the retest level, came back up a little bit and hovered around that level in late January, early March, and now we're back at that level again. Now, will we break back below that level and come back up forward? We have no idea, but now we need to get into why is the market so uncertain right now? The market cannot find direction for anything. There is so much uncertainty going on in the market right now, and investors are not able to digest it. Let me tell you, the market hates uncertainty. And until we get true direction with where we're going in the economy, geopolitical risks, and growth with our companies here in the US, we really truly do not know where we're going. But there's 3 things I want to talk about here today that may help us understand how we can get back on the road to recovery and get back to all-time highs in the market again. The first thing we need to talk about is the Federal Reserve. Now, what is the Federal Reserve? The Federal Reserve is an independent entity. The Federal Reserve has a dual mandate. That means that they have two objectives. One, maximum employment, and two, stabilize prices, i.e., control inflation. We know that inflation has been running rampant right now. Everything is higher at the grocery store, used cars, everything you can think of right now is high. And inflation has been running hot in 2020 and 2021 through a myriad of different reasons. So let's turn the clock back and let's talk about what happened in 2020. Remember in 2020 when the pandemic happened and shut everything down, economic activity was at a standstill. The price of oil per barrel turned negative. You're talking about you couldn't go to the grocery store hardly. You had to get things delivered. You couldn't sit down in restaurants. You couldn't get on a plane. You couldn't have any type of extracurricular activities. People were not spending money on leisure. Theme parks were closed. The NBA went into a bubble. All of these things happened during 2020, and that slowed the economic activity down for the United States and the entire globe. So what the Federal Reserve did was they decided to lower the interest rates, and the government decided to pass a spending bill so we can print money and inject money into the economy. Think the PPP loans that all the businesses got in 2020. Also, with that being said, when you lower interest rates, that increases borrowing power, and that borrowing power allows economic activity to begin. So you had a whole lot of people that were applying for mortgages. So you had demand for housing to skyrocket. When the demand for housing skyrocketed, you had the price of lumber that was skyrocketing. And this is one thing I want us to remember and keep in mind. At least 40% of the money that's in circulation right now was printed over the last 2 years. The more money that you print, the less it is going to be worth. With that being said, that's why the prices have gone up sky high. In addition to that, we've been dealing with massive supply chain shortages. Think about how the fact that people still are not able to get PS5s and Xboxes because of the semiconductor shortages. Semiconductors go in everything. They go in your electronics, all your electronics. They go into your phones. They go into your TV. They go into your refrigerator. They go into your dryer. They go into your cars. They go into our medical devices. They go into everything. And semiconductors really, truly run the world. And so we've had that shortage. We've had home shortages to where we cannot build enough homes for the type of demand that we've got. So what we really have to understand is that we have to stabilize these prices because everything is getting so high. Inflation has gotten to the point to where it's the highest that it's been in decades. So let's talk about what the Federal Reserve actually can do. There are 3 tools that I want to talk about that the Federal Reserve has in their toolbox. Number 1, they can print money. Number 2, they can buy bonds. In other words, they can take on debt. And 3, they can control interest rates. They can raise interest rates and they can lower interest rates. So let's go back to 2020 one more time to explain what they did. The Federal Reserve went into a quantitative easing cycle. So QE for short. Quantitative easing is the Federal Reserve's way to try to generate as much economic activity as possible and allowing people to get as much money as they can as easily as possible. So think printing money. So think stimulus checks, think PPP loans, all those things. Think about buying up bonds. So they were buying corporate debt from companies. And also think about lowering interest rates. They lowered the federal funds rate to 0, and that allowed people to borrow money at all-time low interest rates. The Federal Reserve was buying up corporate debt at the tune of billions of dollars every single month. And so let's not forget about the institutional investors. At the end of the day, the institutional investors are trying to get returns for their clients. The market had certainty in 2020 and 2021 because the Federal Reserve was pretty much providing a lifeline for the economy. They were buying up the corporate debt for these companies, injecting money into these companies to be able to grow their businesses. That gave portfolio managers and institutional investors the license to continue to invest into the market because interest rates were at an all-time low. You could not get any returns from a bond. So at the end of the day, that's why the stock market has some of the best returns that it had over the last 2 years. So now, playtime is over. Inflation is running rampant, and now the Fed has to do something. So now, instead of quantitative easing, now we're going into quantitative tightening, meaning that it's going to be harder for you to get access to money. Now we're going to raise interest rates. They're going to get off of the corporate debt, and they're not going to be buying up those bonds like they were, and they're not going to print as much money as they were either. In other words, the economy is going to have to stand on its own 2 feet. It's not going to have the Fed to come and save itself. It's like Jeremy Lin. It's like way back when Jeremy Lin had a great 6-week run with the New York Knicks. Like, he was playing amazing, unbelievable. But eventually, Jeremy Lin reverted back to the mean, meaning he became who we thought he was, which was just a normal role player in the NBA, not a superstar like the way he was playing. At the end of the day, investors are not convinced that the economy can actually stand on its own 2 feet without the help of the Fed, especially with rising costs and inflation. So now the Federal Reserve Chairman Jerome Powell, along with his committee, the Federal Open Market Committee, have a decision to make. At the end of March, investors are anticipating how much the Fed will actually raise the interest rates to try to taper inflation. Now look, I do not believe that Jerome Powell, the chairman of the Federal Reserve, is actually going to intentionally raise rates too quickly to crash the economy. I believe that him and his committee, they will take a measured approach to make sure that we have a smooth landing and a smooth takeoff to make sure that we get things under control and stabilize prices, which is one part of the Federal Reserve's dual mandate. The second thing that is bringing uncertainty to the markets is Russia's invasion of Ukraine. Now, from a revenue perspective over here in America, about 0.1% of the revenue that S&P 500 companies make comes from Russia. Not 1%, 0.1% of their revenue comes from Russia. So from a revenue standpoint, we're not really worried about Russia. But on the other hand, Russia does control the oil supply for a large portion of Europe. So they could cut supply, and that could raise the price of oil per barrel higher than what it already is. So we really need to figure out what's going on over there. Now, I am not a foreign policy expert at all, and I'm not going to try to even grasp what's going on over there right now. It's sad. But what I will say is that we've got to have a wait and see approach and see what's going on so the market can have some certainty around this conflict. The third thing that investors are worried about is, can the U.S. economy continue its growth? A lot of companies have guided down in terms of guidance, meaning that they're not having the level of growth and the level of revenue and profit like they were having back in 2020 and 2021. You've got companies like Square, Zoom, Teladoc, CrowdStrike, Zscaler, a lot of high growth, high flying tech names whose prices have reduced more than 50 to 70% from their highs. I forgot about PayPal. But the one thing that I want to tell you is that maybe it was justified, maybe it wasn't. Institutional investors need to be able to find the valuation in these companies and see how much growth they actually have in the future before injecting new capital and new money into them. That's why it's very, very key that we continue to invest in companies that are growing revenue, that are growing profit, that are adding businesses, adding services, adding products, and their best days are ahead of them and not behind them. We really have to have discretion and discernment when investing money into these businesses. At the end of the day, we're in a correction. We're not in a market crash. The market just corrected. We're getting back to what the real market is. Back in 2020 and 2021, we were getting all-time highs all the time. It seemed every day we were making a new high. Now it's been almost 60 days since we've actually made a new high on the S&P 500. But I want to give encouragement to everybody. This is not the time to be taking money off of the table. This is time to inject new money into the table during corrections, because once we get the certainty, okay, once we figure out what the Federal Reserve is going to do, once we figure out the conflict over there in Ukraine, and once we figure out the growth with these companies, then I believe that we can get back to business as usual and we can make it back to the all-time highs. It's March, okay? It's the last month of Q1. So you know what that means. Next month is the first month of Q2, and now we're going to start having Q1 earnings. So now this is going to be an opportunity for companies to solidify the growth that they have, and that could give investors the confidence that they need to invest into the market. So we have to play the long game. Even if you buy shares in the market at this level, you buy shares of SPLG or SPY or whatever, and the market goes lower, I will tell you this, and I can guarantee you this: you are buying a whole lot closer to the bottom than you are to the top. We just have to be patient and be able to be nimble in these waters to be able to get the return that we need in order to grow our portfolio this year and beyond. As always, I really truly appreciate it for y'all listening to this episode. Please like, please subscribe, please share. Please let me know how you feel about the economy. Let me know what you think Federal Reserve Chairman Jerome Powell is going to do about interest rates. I am not a foreign policy aficionado, but some people that listen to this podcast, they may be able to give me some game and really truly let me know what's going on over there in Ukraine. As always, I would like for y'all to reach out to me in the comments and let's have discussion and dialogue about current market conditions. This is not the time to take money off of the table. We need to be putting new money to work so we can grow our portfolios. This is the opportunity that some of us have been waiting on. Some of us have not invested at all in 2020 or 2021. This is the opportunity to put your money to work and make your money work for you and not against you. As always, don't pay for it. Trade for it. I'm gonna catch y'all on the next one.